As a part of Models and Scenarios, I manage the GTAS forecasting team for S&P Market Intelligence. I am pleased to moderate and speak at today's webinar, Time, Tariffs and Tracking, Q4 2023, Trade and Supply Chain Outlook. We know a lot of you are interested in getting right into it, but before we do, a few reminders. I want to ensure that this will be an interactive session. Obviously, we are not in person with you, but the more interactive we can be, the better this is going to go. And of course, to do that, we're going to need the questions. So what I'd like you to do is, if you see the Q&A button at the bottom of your screen, go ahead and hit that and submit your questions for us. Don't worry about the punctuation. We're going to be the only ones who can see those questions. If you are watching the replay and you want to be contacted or have any questions, please reach out to us via chat with Market Intelligence bot or the request demo under the related content widget. Also, make sure you look at the different icons. One of those is the related content widget, which includes link to our thought leadership resources. You will also find our webinar replay portal to access this session and other webinars on demand. The elements displayed on your screen can be adjusted in size and can also be minimized and maximized. This webinar also provides closed captioning in English. Please click on the CC icon in the media player to activate it. If you'd like to schedule a private meeting with one of our product specialists, chat with us by clicking on the icon at the bottom of your screen. So if you're interested in what we are talking about today and want to learn more, hit the button and schedule a call. Last but not least, a survey will appear at the end of this session. It takes less than a minute to complete, and it does really help us to understand what you like, what you don't like, and what you like us to cover going forward. Now, please note that the activities of S&P Global Market Intelligence are independent and separate from the S&P Global Ratings. S&P Global Ratings maintains a separation of analytical and commercial activities. Thank you for joining us. I want to introduce my colleague, Chris Rogers, Head of Supply Chain Research at S&P Global Market Intelligence. Thank you, Chris, for joining us today. In the next 60 minutes, we will get to know: are the supply chains getting back to normal? Is the global trade slowing or accelerating? What are the risks to watch in the rest of 2023 and beyond? And when will the environmental policies start to have an impact? And now we have our first poll question, which has popped up on your screen, and we would love to hear from you. The question is: have supply chains returned to normal modes of activity? Which of these is closest to your view? And the choices are: absolutely, there's nothing to worry about; mostly, but I'm reserving judgment until after peak season; there are still shortages and too many uncertainty to be sure; and I don't know, that's why I'm listening to you today. So absolutely, mostly, but I'm reserving judgment. The third one, there are still shortages and too much uncertainty; and I don't know. We'll leave you a few seconds to answer. Okay, the results I'm seeing during the live presentation are 5% absolutely yes, mostly 40%, still shortages 43%, and I don't know around 10%. Chris, what do you think about those answers?
I think a lot of people have turned up today knowing what they know already, which is great, because I think we've all been looking at supply chains long enough now as a result of the challenges faced over the past 5 years to have formulated an opinion as to where we are. I'm surprised that there's only 5% who have nothing to worry about. When we've had conversations with our customers, a lot of them are reasonably relaxed already. I think it's absolutely right to be thinking about peak season, and we'll talk about some of the numbers around that. And certainly, there's plenty of uncertainty to go around. So we'll touch on some of those issues as well. So if it's all right, Agnieszka, I'll kick off with my slides.
Fantastic. Please do.
Cool. All right. So we included the word time in the title of this webinar because we are very much at a point of inflection between past problems and future opportunities. And we use just in time as a reference to inventory balances. I think we've moved from a time when a lot of the concerns in supply chains have been about physical network operations, although as we'll see later on, there's no shortage of those. More to think about what strategies should be followed for the future, whether that's in terms of inventory management, reshoring, multi-sourcing, and so on. Looking at where we are right now, the good news is that there's fewer disruptions to supply chains than there were in the past. The bad news is it's because of a decline in demand for consumer goods. What we're seeing on the right-hand chart here is data from our colleagues in the economics team looking at seasonally and inflation-adjusted US consumer spending. And you could see in their forecasts that we're actually going to see a continued slowdown in durable goods spending. That's the main driver of supply chain operations, driven particularly by the auto sector. And obviously there's a strike going on there at the moment, and we'll talk about that a bit later on. But also in the IT equipment sector as well, with a bit of a marked turnaround coming through during the year. So that slowdown in consumer spending is driving, to a certain extent, the relaxation in supply chains, but also the need for destocking. The other bit of good news is that it would appear to be that in the middle of peak season, we are seeing a return to normal seasonality for a given value of normal, of course. A number of you obviously said you're going to wait and pass judgment on the state of supply chains until we get the other side of the peak season. The chart on the right here, which is a bit of a spider's web, but the orange line is US seaborne imports of consumer discretionary goods. So that's furniture, for example, home appliances, and so on. That's tracking, the shape of that is tracking similar to the 2016 to 2019 average, which is the blue line on that chart. The dark grey line is 2022, and it's an important point to make that we've now got to a situation where for US seaborne imports in the month of September on its own, we're basically back to there no longer being a decline. We had, I think, nearly 17 months of falling trade, and that's how long it's taken for supply chains to get back to normal. That decline has partly been down to demand. It's partly been down to destocking as well. On the topic of destocking, our colleagues that look after the S&P Global PMI, the Purchasing Manager Index, have been showing us some really quite negative data on the state of manufacturing. So what we're doing here is taking a step back up from the consumer level to the manufacturing level, so in the middle of supply chains here, if you like. A PMI number of below 50 is a diffusion index. A number below 50 means a contraction, a reduction month on month. Above 50 is an expansion month on month. What we can see here, the blue line on the chart on the right is new orders for manufacturers, and those have been in decline now since the middle of last year. And the rate of decline has only decelerated a little bit recently. That's meant that the quantity of purchases has been coming down as well, because the backlogs of work, which is the yellow line, so that's how much work manufacturers have left to do, is still declining. So, that to me suggests that, supply chains have gone from facing kind of an embarrassment of riches to now potentially a glut of business availability. And that's really now eating into supply chain activity more broadly. So we've gone from consumer to manufacturing. We'll step up another level now by looking at trade. So, Agnieszka, here's your first slide. Off you go.
Thank you. This is a general trade volume forecast, and that's how it looks for now. The outlook prediction for 2023 not stunning because soon we'll be summing up the 2023. And it seems that we'll close it with a negative growth rate in total trade volume for the world's total. Current estimate in GTAS forecasting is minus 1.7%, mainly due to already historical data for quarter 1 and quarter 2. Our forecast brightens up for 2024, but it will be more certain after the Q3 data are already historical. For now, it amounts to around 2%. But as you can see from the yellow line, we do not anticipate a strong expansion in the long run. So the main drops in 2023 in volumes are, as Chris already mentioned, imports to the US, but also to the EU. Both were down by around 7-8% in comparison to year 2022. And on the export sides for both EU and US, we also predict the negative growth rates in 2023, but that should brighten up in 2024. I will move right now to the quarterly view on the forecast, the shorter term. So as we can see, this most significant drop already happened. It was in quarter 2. It was almost 7% drop comparing to the corresponding quarter previous year. As I mentioned, it was mostly the outcome of the decline in imports of the US and EU. But as we track the monthly historical data, Chris was mentioning already about the September data and the C imports to the US, the C imports to the US in August. So the indicator for quarter 3 were showing a 6% decline still. So our estimate for the quarter 3 right now, total trade is positive, but it is 0.1%. In plus on the total trade only. We predict a little bit higher data in quarter 4 and then in 2024. And now let's see how those US imports look like. So the decline in US imports is caused mainly by the drop in imports from China. China imports to the US have been impacted by Section 301 tariffs and by the not so strong consumer demand. It does not mean that we anticipate significant drop in China total exports, because yes, imports from China to the US were around 8% in volume terms in 2022. So the share of imports to the US, and now it is only 5%. But it seems that China long-standing position in the world as the world's largest exporter is still holding. So China's share of exports in Asia to the rest of the world in volume and value terms is unchanged since 2020 at 15% and 5% and 63% respectively. And also the share of global exports of China is steady at 5% in volume and 15% in value. So it seems that China is diversifying the markets for its exports while it struggled in the North America due to the tariffs and pullback in consumer spending. So its market share is, if not growing, then standing steadily to the other markets. And I mentioned about the US, and now to the EU, the other region that was showing the decline in 2023. So the drop in the EU imports was caused by the decline in imports from Russia. In volume terms, Russia shares in the EU imports of the most significant commodities like petroleum, oils, and natural gas have been decreasing continuously over the time since the second quarter of 2022. Crude oil imports from Russia fell from 22 million tons in the second quarter of 2022 to 1.2 million tons in the second quarter of this year. So I mentioned that our forecasts actually estimate already for 2023 in volume for the trade, global trade, is minus 0.7%. Let's look at the estimates that other international institutions are providing to you. Here is the WTO estimate of 1.7%. Actually, it was changed last week. They downgraded the projection of the trade for 2023. They cut it in half, actually. So right now, the estimate of the volume growth for 2023 is 0.8. Yeah. But I think that not only WTO, but other institutions like IMF and World Bank are going to downgrade their estimates further, because, as I remind you, our estimate is in minus, so it is almost 2% drop. Okay, and now, before I hand over to Chris, who will talk about the risks to watch over the rest of 2023 and 24, I want to introduce to you the S&P Global event, the TPM conference, which is on the next slide. TPM 24 is the premier container shipping supply conference. The event brings senior management and corporate logistics and supply chain teams together with ocean carriers, logistic providers, ports, trackers, railroads, and others who facilitate international container and air cargo supply chain. Build your expertise and your network through an editorially independent program of keynotes, fireside chats, panels, TED-style talks, shipper case studies, and the TPM Academy, plus unparalleled networking. Join us in the Long Beach, California, in March 3rd through 6th, 2024, for the 24th annual TPM. I am pleased to be able to share an exclusive discount code for 50% off current ticket prices, SPGWeb15. Please visit the events.joc.com/TPM to register today. And now I hand over to Chris.
Yeah, thanks very much, Agnieszka. I'm looking forward to being at TPM. It's nearly, 5 months' time, and there's a lot of change to come in supply chains between here and then. I think coming back to this topic of time and timeliness within supply chains, I think one of the key risks that supply chains face, both currently and going into next year, are around strikes and labour risk more broadly. We've had a period of elevated price inflation over the past couple of years. We've had increasing corporate productivity and profitability in a number of different industries. And it's perhaps therefore not a surprise that we're starting to see strikes come to fruition. We've been lucky in the world of supply chains to have avoided strikes earlier this year, both in terms of the US West Coast ports and the US rail networks. But in terms of the United Auto Workers strike, that is an issue right now. It is something that's going to be an issue. I think our core view is it's going to continue for some time yet, and will have a measurable impact on US gross domestic product as well as the auto industry itself. We've had a couple of questions already about the impact of the strikes and also border issues in North America on the auto industry. So we'll get to those a little bit later on. We do also think there are risks in Europe. IG Metall have a lot of negotiations in Germany coming up in November. In other countries as well, we've seen unions strike quite a militant tone with regards to wanting to see higher wages. The chart on the right here is showing from our colleagues in our price forecasting team their expectations for manufacturing average hourly earnings. This is a rebased number. They're going to steadily increase, particularly in the automotive sector over the next couple of years. And we're talking about mid-single digit rates continuing. That has a couple of impacts, right? First, if you have a strike, it directly impacts your supply chain. Second, if you have a pay deal to fix it, that's going to increase your costs and reduce the funding available to invest in supply chain resilience going forward. One of the things we'll be talking about at TPM is the cost of resilience, and we'll be writing a wider report on that ahead of that conference. We're also, as I mentioned earlier, beginning to see something of a lack of willingness to pay for just-in-case inventory strategies. So what we mean there, historically, just-in-time, very lean approach to inventory management. You get products delivered just as you're ready to sell them on if you're a retailer, or to use them in your factory if you're a manufacturer. And there were discussions during the pandemic when we had all these shortages about whether it would be better to have a just-in-case approach where inventories are held at a higher level. What we've been finding there is that there's very little evidence of retailers being willing to do that. The chart on the right is showing US retail inventory to sales ratio. That's seasonally adjusted through July of this year. You can see the blue line down the bottom is the ratio for all retailers excluding motor vehicle and parts dealers. That's basically back to where it was in 2017 and 2019. For the furniture sector, similar story, back to where it was in the past after a period of destocking that we've had already. On the retail side for clothing and clothing accessory stores, we're still seeing an increase in inventory to sales ratios, but only really close to historic levels rather than being anything well above that. So if we are seeing a general approach to being leaner again in inventories, then that removes a support for a number of different parts of the industry, including logistics and including warehousing. And obviously it's a part of Agnieszka's forecast that we talked about a few minutes ago. The PMI for manufacturing inventories is similar. We're still seeing the PMI be in contractionary territory for manufacturing inventories, really across all the major sectors that we track. And again, none of this should really be a surprise, given that we've got a high interest rate environment at the moment. If you increase your inventories, that is, of course, going to cost a lot of extra money. And there's few finance departments at the moment that are willing to have that form of debt if it's really not required. And if supply chains are running smoothly and demand is lower, that's perhaps not a surprise. I think another area of development that may be at risk is multi-sourcing. So this is buying from more than one supplier. We're going to be publishing research in the not too distant future on this topic, looking at it in more detail. But we did see an uptick in the number of sources used on average during the pandemic era. And it's not immediately clear that that's going to prove to be permanent. Reshoring, which is distinct from multi-sourcing, so you could multi-source from one country. Reshoring, you could just buy everything from one different country to where you've been in the past. Reshoring does seem to be very much in flight still, and that's linked in part to the geopolitical risks that we're seeing. On the topic of time, we're going to wind the clock back to the bad old days